Good morning, hunters. Welcome back to the Daily Hunt for Multibaggers on this Saturday, February 14th, 2026.
That's right, and we've got a fascinating batch of AI-generated insights for you today, compiled from Friday's market chatter.
We saw a lot of activity across the board. Many different stocks were flagged, especially the big names. It really feels like a mixed bag out there. Some real promising growth stories and, well, some clear areas of caution.
Indeed, while there's definite community optimism around certain sectors, our data also flagged significant risk factors for several companies. It's crucial to look beyond the headlines and into the underlying metrics, as always.
Absolutely. Let's jump right into it. First up, the AI darling NVIDIA, symbol NVDA. The chatter around this one is always intense. And we're seeing strong bullish catalysts here. Goldman Sachs is predicting a beat and raise quarter, and the CEO is signaling a long AI infrastructure runway. Major tech companies are pouring hundreds of billions into AI capex. That's pure growth potential right there. And last time we looked at NVDA on February 10th, we were saying stay away. But this new data, it's really shifting things.
Well, Ethan, while I appreciate the enthusiasm for growth, let's not overlook the KPIs. NVDA's price-to-earnings ratio sits at a high 45.25. That indicates a significant amount of future growth is already priced in, making it vulnerable to any deceleration. And with a beta of 2.314, you're looking at significantly higher volatility. Plus, there's been some net insider selling over the last 6 months, and the looming threat of stricter U.S. controls on AI chip sales to China could impact a major market. We also have an earnings report coming up on February 25th, which could swing things either way.
Fair points, Brooke. But that 62.5% revenue growth and 53% net profit margin, that's exceptional efficiency and market capture. For growth-oriented investors with a high risk tolerance, this could still be a fantastic long-term play despite the volatility.
It's a high-reward, high-risk proposition, certainly. But for today, given the updated insights, I think we can say for NVDA, it's an investigate as buy. We're upgrading it from stay away. Moving on to PBR, Petroleo Brasileiro. This one just popped up in our analysis, a first-time mention.
Yeah, and there was a user post talking about some really impressive gains they made on PBR, like over $37,000 up on a margin trade. They loved the dividend yield, too. That shows the potential for big returns, right?
Potential for big risks, too, Ethan. The overwhelming sentiment from the community was bearish, advising the user to sell it now immediately, calling it a widowmaker and warning about a flawed dividend strategy. Our KPIs reinforce that caution. Negative revenue growth at minus 0.013 and a staggering debt-to-equity ratio of nearly 88.5. This company is highly leveraged, and despite the low beta, the specific political and commodity price risks of an emerging market state-owned oil company are substantial.
So the user got lucky, basically.
Pretty much. For PBR, our AI-generated analysis suggests stay away.
All right, next up, AMZN, Amazon. This is a Mag 7 staple, an established name. The community chatter was really bullish here, with a user celebrating significant gains over the last 8 months, explicitly crediting AMZN. They're avoiding the FUD and sticking with fundamentally strong companies. We previously had AMZN as stay away yesterday, February 13th.
And the KPIs certainly back up that fundamental strength. A low debt-to-equity ratio of 43.435, excellent return on equity at over 22%, and robust revenue growth of 13.6%. Insiders have also been net buyers over the last 6 months, which is always a positive signal. And news about Amazon-backed X-Energy reactor gaining U.S. approval, that's diversification into advanced tech. This looks solid. Sounds like a clear upgrade then. For AMZN, our AI-generated commentary indicates investigate as buy. Now, let's talk about CVNA, Carvanaco. The user discussion here was pretty stark, describing a profitable bearish options trade, with one comment saying, every time someone makes money shorting CVNA, the world heals a little. We rated this stay away on February 12th.
Well, options trades with 7x returns can be exciting, showing the stock's dynamism. It means there's a lot of movement and potentially rapid gains, even if it's on the downside.
But Ethan, the underlying financials for CVNA are incredibly concerning. An astronomical price-to-earnings ratio of 78.10, coupled with incredibly low revenue growth at 0.545%, screams massive overvaluation. And the debt-to-equity ratio, it's 192.4, which is just extreme financial leverage. Insiders have also been net sellers, offloading over 21% of total shares held. News reports mention $1 billion accounting questions and headlines like Carvana can't stop falling. There's an earnings report coming up on February 18th, but these are serious red flags.
Okay, those are some pretty heavy numbers, Brooke. It's hard to ignore that level of risk.
For CVNA, our analysis remains a firm stay away.
Moving on to APL, Apple Inc., A user actually mentioned hitting 100% gains on APL puts, indicating a successful bearish trade in the past. But for me, the future looks bright. News reports are optimistic about Apple's upcoming hardware and AI updates. Insiders have been net buyers over the last 6 months too. We had this as a buy on February 10th. While the insider buying is a positive, the overall sentiment from users for APL in this specific dataset was quite neutral, based on a past trade rather than a current outlook. From a KPI perspective, Apple's PE ratio is still quite high at 32.38. And while they have fantastic profitability, a debt-to-equity ratio of over 102 indicates significant financial leverage for a company of its size. Plus, there are news items about Siri delay struggles, which could impact future growth and market perception, especially in the competitive AI space.
So you're saying it's priced for perfection, and any hiccups could hurt?
Precisely. The moderate revenue growth of 15.7% might not fully justify that high PE and debt without some groundbreaking new catalysts delivering immediately. For APL, our AI-generated insight suggests stay away. That's a downgrade from our previous buy rating. And finally, we have NXXT, Next NRG Inc. This one has seen a flurry of activity and honestly some mixed signals. We last rated it speculative gamble on February 6th.
Yeah, the user posts were incredibly bullish, Brooke. They talked about NXXT being poised to ride the fleet electrification wave, securing municipal and utility-adjacent deals for long-term stability. They highlighted Q3 revenue growth of 232% year-over-year, and even mentioned big institutional players like Goldman Sachs expanding their positions. They're terminating at-the-market sales to reduce dilution. This sounds like a company with a potentially transformational growth pathway.
It sounds like a strong narrative, Ethan. But when we look at the KPIs, the picture is far grim. NXXT is deeply unprofitable, with a net profit margin of minus 0.86, meaning they're losing 80 cents for every dollar of revenue. Their price-to-book ratio is a shocking minus 6.19, indicating negative shareholder equity. Essentially, their liabilities exceed their assets. And despite the bullish posts, the stock is trading near its 52-week low, having plummeted from over $3 to around 80 cents in a year. But the future potential with these strategic partnerships for government and defense and that revenue growth, can't that turn things around?
It could, Ethan, but it would require an incredible turnaround from a financially distressed position. And crucially, there was also user sentiment explicitly calling NXXT spam marketing pump and dump and a fucking ridiculous company. While there's net insider buying overall, we also saw a news item about a director trimming their stake. The financial fundamentals are too weak to justify a positive rating right now, even with exciting future prospects. For NXXT, our AI-generated analysis suggests stay away.
All right, Brooke, time for our roundup. Based on today's AI-generated insights, here are our candidates for deeper analysis. Investigate as buy, Amazon.com Inc., NVIDIA Corporation. Investigate as cautious buy, none. Investigate as speculative gamble, Next NRG Inc., NXXT. And that wraps up another episode of the Daily Hunt for Multibaggers. Before we go, a quick reminder. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for tuning in, everyone. We'll catch you next time on The Daily Hunt. Happy hunting!